So welcome everyone to this revision session of India's 23. This is going to be a very quick revision session, which is going to be in 100% English, where I'm quickly going to revise all the concepts along with the important questions. So if you're watching this video, if you like it, do subscribe and hit the like button. Also, you can find the board notes on my Telegram channel. The link is in the description. Also, if you would like to recommend my lectures to your friends, they are available on bbvirtuals.com. Okay, so on that note, let's start a very quick revision of India's 23 in 100% English in 3, 2, 1 and go. First of all, what is the meaning of borrowing cost? So in case you remember, I made you write it in your notes, right? So if you want, you can just refer the whatever loan you take. Okay, and if that loan is taken for a qualifying asset, let's say whatever loan you take, you pay interest on it. Okay, and if that interest you paying, that is known as borrowing cost. Okay, now interest can be of two types. It can be a coupon interest, it can be a EIR interest. In India's 109, we have thought what is EIR interest, a combination of coupon, discount, premium, transaction cost. Now, what will happen with this borrowing cost? Normally we transfer it to profit and loss, but Index 23 says if you are incurring the same on a qualifying asset, you can capitalize it. Okay, what is the meaning of capitalizing? You can add it to the cost of the asset. But if you are not incurred on the qualifying asset, you can transfer the borrowing cost to profit and loss. Now the question is, what is the meaning of qualifying asset? Qualifying asset is any asset which takes substantial period of time to get ready for its intended use or sale. What is the meaning of substantial period? It is a matter of judgment. That means if any asset which is taking time to get built, for example, you are constructing a building by yourself. So if you are constructing it, it will take some time, maybe 12 months, 2 years, 3 years. That time which is taking, it is known as substantial period of time to getting ready for its intended use. So if you are constructing a PP by yourself and if you fund the expense through a loan, the borrowing cost on that loan can be capitalized. But let's say for example you took a loan and you are buying a ready-made flat. That ready-made flat is not a qualifying asset. Why? Because it is not getting ready. It is not taking time to get ready. It is a ready-made flat. Okay, so in that case the interest which you are paying on this loan will be not be capitalized. It will be transferred to profit and loss. Of course, now then we discussed a charge. So it is given here definition of borrowing cost. Then what is the meaning of qualifying asset? Do remember, it is never written anywhere that 12 months is a substantial period. It is a matter of judgment. For some companies it might be 4 months also, for some companies it might be 12 months also. Okay, so always write a note whatever you are assuming in the exam. Acha. Then treatment of borrowing cost. How will you treat the borrowing cost? So if you have incurred on a qualifying asset, you will capitalize it. If you are incurred on a normal asset, so you will expense the borrowing cost out. Now borrowing can be of two types. One can be specific borrowing, one can be general borrowing. Always remember, if there is a specific borrowing, what to do. So we have taken few examples also to discuss it. You can refer the examples in our board notes, but just listen to me carefully. In case of specific borrowing, let's say for example you took a borrowing today. In specific borrowing, never see when did you utilize the funds. Just check the capitalization period. When did you start the construction? When did you end the construction? During that period, full interest you can capitalize. In general borrowing, we see how much expenditure we have spent, but in specific borrowing, we will not see that. You will just see when did you start the construction of qualifying asset and when did you end it. During that tenure, whole interest you can capitalize. Okay. Yes, from that interest, because you won't be using the full funds on first day, from that interest you will also deduct any investment income on temporary investment of these borrowings. So if there were any idle funds which you invested and earned any income, that you will reduce it. Acha. If there is a general borrowing, what to do? In general borrowing, there are two steps involved. First step is finding the capitalization rate. Let's say there are pool of funds, there are multiple loans which are there. So you will find a weighted average cost of capital. How will you find it? Total interest which is weighted average divided by total borrowings which is weighted average into 100. You will get a rate. Okay, and then that is step number 1. Step number 2 is finding the borrowing cost to be capitalized. How will you find it? Just multiply the capitalization rate on the expenditure which you are incurring on every month, right? So let's say you incurred expenditure in the month of April. So you will say that expenditure into the rate into the number of months the capitalization was there. Acha, if you incurred the expenditure in July, so you will say in the July the expenditure incurred into capitalization rate into the months starting from July. Okay, that is how you will do it. Okay, acha, do remember this is a quick revision. I am focusing on revision rather than teaching you for the first time. Okay, do remember that. Okay. So we did certain examples based on that also. Then we moved on towards the next point, which was period of capitalization. How many months will you capitalize the interest? So that means there are 3 terms here. Commencement. Commencement means when will you start the capitalization? When 3 conditions are met. First, expenditure should be incurred. Second, activities should be undertaken. The activities can be planning or any physical activity, and also borrowing cost should be incurred. When all the 3 are met, only that is the time when you will start the capitalization of interest. Okay. Next is suspension. Suspension means during your period of capitalization, is there any period during which active development was not taking place due to abnormal reasons? For example, let's say I constructed an asset which took 10 months. But in those 10 months, 1 month the workers were on strike. So can I say for this 1 month there was no active development taking place? So you will capitalize the interest only for 9 months. Okay, then let's say a second example. Let's say you worked for 10 months. Okay, but during 1 month, the construction was halted. Why? Because let's say we were constructing a bridge. So it was required to dry the bridge, the cemented road which we are building on the bridge. So for drying process, we were halting the construction. Now, can I say this drying process is a part of your construction? So if the construction is halted and it is a part of your construction, then you will not suspend the capitalization because it is a normal thing. But workers going on strike is not a normal thing. So in that you will not capitalize. Here, if the stoppage of construction is a necessary part of your construction, then you will not halt the capitalization. You will capitalize for the full 10 months. Okay, this was suspension. Next is cessation. What is the meaning of cessation? Cessation simply means when will you stop the capitalization. So you will stop when the asset is ready for use or when the activities are substantially completed. First point, cease capitalization when substantially all the activities are complete. Next point talks about what if the asset is getting completed in parts. That means, let's say for example, I was constructing a full complex where there was 4 buildings. Okay, now let's say these 2 buildings get ready in 18 months only, and the remaining 2 buildings are not yet ready. Now, should I stop the capitalization of interest on these 2 buildings? The answer depends on whether these 2 buildings are of capable being used separately. If they can be used separately, you will stop the capitalization on this 2 buildings and you will continue the capitalization on the remaining 2 buildings. Okay, do remember. So it is mentioned when construction of QA is completed in parts and each part is capable of being used separately, cease capitalization of each part when it is completed. Simple. Okay, then the next point is exchange difference to be treated as borrowing cost. Sometimes what happens is we take a loan from foreign. Okay, so on foreign we have to pay interest. That interest is allowed to be capitalized, but sometimes you also incur exchange loss on the loan. Why? Because when you took the loan, maybe the rate was only, let's say, 70 rupees. Later on the rate went on to be 75. So there is an exchange loss now. So now what to do with this loss? So as per IND AS 23, some part of exchange loss is also allowed to be capitalized. So you can see that. So let's say for example, I took a loan of $10,000 when the rate was 5%. Okay, now the rate, if you took the same loan in India, it was 12%. So that is why I took the loan from outside. Rate when I took the loan was 70 and later on became 75. Okay, whatever interest you are paying on the foreign loan, you will capitalize it. That is fine. Acha, do remember when you are calculating the interest, take the exchange rate on year end because you are paying the interest on year end. Okay, then there is exchange loss also because the rate increased. You are incurring a loss of 50,000. Now out of this loss, some amount is allowed to be capitalized. How much? Calculate 2 amounts. First, interest on equivalent amount of loan from India. Second, interest on foreign loan. If you took the loan from India, you would have incurred an interest of 84,000. Reduce the interest already allowed to be capitalized. Can I say this 37,500 was already allowed to be capitalized out of this much? Reduce it. You'll get a balancing figure. This much exchange loss you can capitalize. Okay, so out of 50,000 I can capitalize 46,500 exchange loss. Balance loss will be transferred to P&L. So how much total borrowing cost did I capitalize? 37,500 plus the exchange loss. Acha. Also one more thing, if in the first year instead of a loss you got a gain, then what to do? If you got a gain, transfer it to P&L. Nothing to be done. That is what I'm talking about in the first year. But there is one more concept. Solved example I will discuss later on. See, acha, let's discuss only. Let's say for example in the first year you got a loss of 10,000 you got. Out of 10,000 you capitalized 2,800. But if on the same loan in the next year, in the second year, you got a gain. So to the loss what you did, this much loss you capitalize. So if on the same loan you get a gain in the next year, so to the extent of previous loans, this gain will be reverse capitalized. What is the meaning of reverse capitalize? Capitalization means adding to the cost of asset. Reverse capitalizing means reducing from the cost of asset. But that is only done when you get a gain in the next year. So I had summarized this here as well. If in the first year you get exchange loss, you capitalize this much loss. Okay. If in the same loan on the second year you get a gain, to the extent of previous loss, that much gain will be reverse capitalized. Balance gain, if any, will be transferred to profit and loss. Okay, but If in the first year itself you get a gain, then don't do anything. Okay, the reverse capitalizing gain part only comes into picture when you get a gain in the subsequent years. If you got exchange gain in the first year itself, do nothing with it. Okay, okay, sir. So this was the concept of exchange loss. Then there are some other relevant concept also. First is, if you raise money through preference shares, okay, and that preference share is classified as a financial liability as per Ind AS 109, the dividend paid on those preference shares will be treated as borrowing cost. Second, capitalizing borrowing cost in group financial statements. For this, we will refer illustration number 15. And then cessation of capitalization for maturing inventory. Sometimes, let's say we are preparing a whiskey or wine. Okay, for some companies it might get ready in 3 years. So your qualifying asset period is 3 years. So you will capitalize the interest of 3 years. But some companies might argue that for them the wine is getting ready in 5 years. So they can capitalize the interest for 5 years only when they can demonstrate that from 3 years to 5 years some active development is taking place. Okay, if you're not able to demonstrate, you will only capitalize for 3 years. Simple. With that, all the concepts are done. Now let's focus on the questions. Do remember that in Ind AS 23 your focus should be more on questions only. Of course we are revising the questions, but you have to self practice those questions. Okay, I will revise just the important ones with you. The first good question which I feel is illustration number 13, which you can see. Okay, what is there? So we have a specific borrowing. Also we have a general borrowing. Okay, and this is the expenditure which we have incurred. Now they are saying that the construction was completed on 31st January 18. What to do with this? So in this case we have one specific borrowing as well as we have one general borrowing. What to do? So whenever you are spending the money, first you will utilize the money of specific borrowing. Okay, so let's say I had a specific borrowing of 2 lakhs. So the expenditure which I incur in April will be funded by specific borrowing. The expenditure which I incurred in August, some of it will be funded by specific borrowing. Let's say I had 2 lakhs, out of which 1 lakh 50 I utilized in April. Remaining 50,000 I will spend in August, so that 50,000 will be funded by specific borrowing. Do remember, in case of specific borrowing, I am not concerned with when did you spend the funds. I will capitalize the full interest. So for solution purpose, I can show this to you. Wait. Here it is, I guess. Yes, see. So we have a specific borrowing. Okay. Now when I spend the funds on specific, I'm spending some in April, some in August, doesn't matter. Full 2 lakhs interest you will capitalize, but only during the construction period. Construction got over on January 31st. So you will capitalize the 10 months interest on complete amount. Okay, 15,000 will capitalize. Idle funds information not given, so you will not deduct any interest income. Okay, then for general borrowing you will find the capitalization rate. How will you find it? Total weighted average interest divided by total weighted average borrowings. This is how you will do it. Okay, so you will get a rate. While calculating this, do remember that this you are only finding for general borrowings. Don't consider specific borrowing here. Okay, then for the remaining expenditure, we will assume that they were funded by general borrowing. So expenditure into rate into number of months. Expenditure into rate into number of months. Simple. That is how it is done. Okay, entry was also asked. So this is the borrowing cost to capitalize, and total expenditure incurred on asset will also be capitalized. So you incurred 8 lakhs. Apart from this, you capitalize the interest also. So this is the total interest capitalized. Now entry was asked. So I passed the entries. I gave two alternatives. One, if I'm assuming that interest is to be paid in future, so I will create a payable. If I assume that interest is paid only, so I will say building to cash back. Simple. Clear? Then I guess we also have illustration number 14, which is very good illustration. The only difference is everything is given in statement format. So we have the expenditure given. Okay, now the important part here is they have given statement format. First statement says that we have a specific borrowing of 10%. Okay, the only difference is in the previous question the loan was given directly, 10% loan, this much principal. Here it is given in statement format. First 10% loan, 7 lakhs is the principal amount, and interest amount in case of specific borrowing is directly given. 65,000 was the interest, 20,000 was the income earned. So net it off and 45,000 will be capitalized. Then you have these two general borrowing. So for general borrowing, find the capitalization rate. How will you solve this? So find the capitalization rate 11%. First, whatever expenditure you incur, it will be funded by the specific borrowings. So full specific borrowing interest will be capitalized. Remaining which were not funded by specific borrowing, you will use general borrowing. So general borrowing expenditure into general borrowing capitalization rate into the number of months you will do it. Simple. Borrowing cost to be capitalized. Then what will be there? Okay, one sec. Yes, perfect. 14 was done. Then we come towards question number 15. So this is that concept where we have 3 subsidiaries and 1 parent company. So let's evaluate them clearly. First subsidiary had a borrowing of 10 lakhs at the rate 7%. Okay, now you have a borrowing also and you are incurring the expenditure on qualifying asset also. But do remember, the expenditure you incurred is 15 lakh 40, but the borrowing is only 10 lakhs. So you will capitalize only on this 10 lakhs. What about the remaining funds? From where did the company bring that those remaining funds? They might have used their own resources. So you will not calculate the borrowing cost to be capitalized on 15 lakh 40 because full 15 lakh 40 was not funded by a loan. Only 10 lakh was raised, so on 10 lakh into 7%. This much is what you will capitalize in case of first company. You can see 10 lakhs into 7%, simple. Then construction company, they also incurred expenditure on qualifying asset, but the main part here is they did not raise any borrowings. So no borrowings, no borrowing cost, then no capitalization. So nothing to be done. Nil borrowing cost will be capitalized in construction company. Do remember. Okay. Finance company has a borrowing, but they don't have a qualifying asset on which they are incurring the expense. So if there is a no qualifying asset, you will not capitalize the interest. So nil interest will be capitalized. Nothing will be capitalized. Then they have also asked from the point of view of parent. Now from the point of view of parent, just remember few things. From the point of view of parent, it doesn't matter whether you have funded the expenditure by yourself or not. From group point of view, just see how many borrowings do you have. I had two borrowings, one of 10 lakhs at the rate 7%, 20 lakhs at the rate 7%. Two borrowings I had from group point of view. Second, from group point of view, how many expenditure was incurred on qualifying asset. So this 15 lakh 40 was incurred on qualifying asset, but this includes the intercompany margin, intercompany subsidiary margin. So reduce that. So if I remove the margin, the amount comes to 14 lakhs. One expenditure on qualifying asset. Second, construction company also incurred a expenditure on qualifying asset of 10 lakhs. Doesn't matter whether they use the own resource or not from group's point of view. From group point of view, you incurred expenditure, we will assume that you incurred it from borrowings only. So this is the second expenditure. Expenditure into the rate into the number of months, capitalize this interest. So when you are talking about group point of view, doesn't matter whether you have used your own resources from individual point of view. Just see how many borrowings you have, just see how much expenditure you incur. Simple. Okay, then this was illustration 15. Then we do illustration number 16. The only difference here is now EIR also comes into picture. So it is a combination question of financial instruments and borrowing cost. So normally in the previous questions only coupon was given. So we were capitalizing the interest based on coupon, assuming that coupon EIR is same. But I told you while revising the concept also that if EIR is given, you will use the interest of EIR. So it says that the qualifying asset went on for construction of 2 years. So 2 years interest you will capitalize, but you will not capitalize interest as per coupon. Capitalize the interest as per EIR. The issue is EIR is not applied on face value. It is applied on fair value. You will understand this if you have studied financial instruments, right? So first you will have to compute the fair value as per the financial instruments chapter. So I will show it. This is how it is done. So here it is. As per our approach, we find the cash flows first and then we find the fair value of FL. Because there is no relationship, no CFI, no level of input, you can directly assume the fair value to be day one's transaction price of 1 lakh 80 rupees. Okay, then EIR is given, then LAT will prepare. You will apply the EIR on the opening fair value. So accordingly, you will find the interest of 2 years because the construction went on for 2 years. This 2 years interest you will capitalize. Simple. Let's proceed further. This was illustration 16. Then illustration number 17, you can just refer. It is very simple question. Okay. Then question number 1, a very interesting question. What does it say? It says that we started the construction in September. Okay. We had 2 borrowings. Note here only capitalization rate is asked. They have not asked how much borrowing cost will you capitalize. So here only capitalization rate is asked. So how will you find it? Total weighted average interest divide by total weighted average borrowings. Now how much borrowings did we have? 2 borrowings we had. One is debenture and one is overdraft. For overdraft, see how it is given. Overdraft of 4 lakhs was increased to 8 lakhs in December 18. Interest was paid on the overdraft at 12% until 1st October and then the rate was also increased to 15%. Now how will I solve it? So before solving, there are certain assumptions which are taken in this solution. So you need to remember those assumptions. Okay. What are the assumptions, sir? Wait, I will show it to you. The first assumption is that the year end is December. Okay, first assumption being that the year end is December. Second assumption is that even if the construction started in September, the loan was there for full 12 months. When I find the capitalization rate, while finding capitalization rate, I'm not concerned with the construction period. While finding the capitalization rate, I find it for per annum basis. Okay, so I'm assuming that loan was outstanding for full 12 months. Okay, now how will I compute? So debenture I had 30 lakhs at the 9%. Very good. Overdraft. What was written? I just bifurcated it. It was said that till December you had 4 lakhs. Then in December you raised 8 lakhs. Okay. So for 11 months, the principal amount was 4 lakhs. For the last 1 month, it was 8 lakhs. Then Out of this 4 lakhs 11 months, they are saying that for the initial 9 months the rate was 12%. So for the initial 9 months it was 12%. Then when the principal amount was 4 lakhs, for the balance number of 2 months the rate was 15%. And when the amount became 8 lakhs, the rate was also 15%. I just bifurcated what was given in the solution. Now simple, finding the capitalization rate, total weighted average interest divide by total weighted average borrowings. How will you do it? So I will just use the information. I prepare a working note number 1. In total interest, the debentures interest, 30 lakhs into 9% to 12 by 12. Okay. Then overdraft, how will you find the interest? See, can I say the 4 lakhs when the principal amount was 4 lakhs? For 9 months, the rate was 12%. So I will say 4 lakhs into 12% 9 by 12. Then when the principal amount was 4 lakhs, for the remaining 2 months, the rate was 15%. So 4 lakhs into 15% into 2 by 12. Then for the remaining 1 month, the rate was 15% at 8 lakhs. So 8 lakhs into 15% to 1 by 12. You will get the total interest. Then you want the total borrowings also. One simple hint I gave you. Just remove the rate here. If you just write this same calculation without the rate, you will get the borrowings also. Total interest divided by total borrowings will give you the rate per annum. Okay. So this is how you solve it. Acha, one more interesting part is there. They have a similar question also. That is illustration number 12. Same it is there. But here the assumption is different. Here they have assumed that the loan was not outstanding for full 12 months. It was outstanding only for 4 months. So that is why they have not taken 9 by 12, 11 by 12. They have taken 4 by 4, 3 by 4, 1 by 4. That is how they have taken. How do we solve this in exam? So I have thought one approach of taking 12 months. You can also practice this approach and solve it in exam as per this approach only. Okay, if nothing is mentioned, you can assume anything and write a note of whatever approach you are following. If in question they specifically say that loan was taken on this particular day, then fine for 4 months. If it is said that loan was taken on first day, then fine for 12 months. Simple. So apply your logic in exams. As simple as that. Okay. Then we have another question. That is question number 2, which is also very good. What does it say? It says that we have a qualifying asset. Okay, and we have a borrowing at 11%. Now, how are the cost given? So do you remember they used to give in this month we spent it this much, in this month we spent it this much. So they have given in September we incurred this much cost, in October we incurred this much cost. So month wise cost is given. But the issue is cost is given based on 2 approaches. Accrual basis also cost is given, and how much expense do you actually incur, that is the cash basis also it is given. So first you have to find borrowing cost to be capitalized based on both the approaches. If you take this cost accrual approach, how much borrowing cost will you capitalize? So if you want to calculate, it is very simple. The calculation is very simple. You can see this. So you will say you incurred the expense September. So the September expense into the capitalization rate into 7 by 12. Why 7 by 12? September to March. Then you incurred the expense in October. So you will say October expense into 11% into 6 by 12. So you will find the borrowing cost based on the cost accrued first. Then find the borrowing cost based on the expenditure actually incurred. Okay. So if you don't see this column, if you consider this column, what will be the borrowing cost capitalized? So we find the borrowing cost to be capitalized as per 2 approaches. As per accrual, cost accrual approach, and also as per the advance paid approach. Now which one to consider? So standard says in borrowing cost, it is more relevant value actually incur the expense. So the cash basis, cash outflow basis borrowing cost is more relevant, they are saying. Okay. So we have also mentioned the same. Do remember that. So this was question number 2 which we did. Apart from this, there was also one more question, question number 3, which says, do you remember building A, building B? It became ready early. So only for that particular portion you will cap. Let's say they are saying that we have building construction in 4 phases. Phase 1, phase 2, phase 3, phase 4. These 2 phases are ready early and they are capable of being used. So they are saying these 2 phases are ready mid of the current year. So only for 6 months you will capitalize this much interest on this phase 1, phase 2. For the remaining second half, you will not capitalize on phase 1, phase 2. But for phase 3, phase 4, they were not yet ready for the whole 12 months. So you will capitalize the interest for whole 12 months. So this working also I have given. How will you solve this? You can just see here. Here it is. See. So expenditure total incurred was 221, but I did not have the full loan. I took a loan only for 200 lakhs. So do remember my total interest for 30 lakhs. Now directly don't calculate interest on the expenditure incurred. Why? Because the whole expenditure was not funded by a loan. Okay, we took a less amount of loan. So bifurcate this interest based on the expenditure incurred in phase 1, phase 2 and phase 3, phase 4. So out of 221 lakhs, I incurred 98 lakhs in phase 1 and 2. So proportionate interest of for phase 1 and 2 this much. Okay, and proportionate interest for phase 3 and 4 is this much based on the ratio of cost incurred. Okay, now phase 1 and 2 were ready in the first 6 months only, so capitalize in only interest for 6 months, remaining interest profit and loss. Phase 3 and 4 were not ready for the full year, so capitalize the full 12 months interest. That's it. This was your illustration number 3. Then we have a solved example which I already taught you. First year I got a loss, some amount you can capitalize. In the next year if you get a gain, that gain to the extent of previous loss will be reverse capitalized. That we already discussed. With that, we have completed a very quick revision of Ind AS 23 borrowing cost. Try to be a little quick with this because there are not much concepts to be revised. More focus should be on questions. So of course this revision was just to give you an overview of the questions. Do practice the question on your own as well. Okay, so on that note, thank you so much. I hope this was helpful. If it was helpful, do leave a comment if you're watching this on YouTube. Okay, thank you so much. Bye bye everyone, take care, see you all. Bye.